Hey guys, this is Tammer Fakhry. I'm broker owner of Elite Mortgage.
Hey guys, what's up? It's me, Mickayla Fatovic, and I am the broker owner of Elite Class Property Management and Real Estate Company.
Hi guys, please remember to like, subscribe, and hit the bell icon for notifications.
All right, we're going to be talking about what today, Tammer?
All right, so today we're going to be talking about a topic that we get questions a lot about in the mortgage company, and that is, how do I qualify for a mortgage as a self-employed person? One of the things that we get a lot of questions on is, well, if I want to get a mortgage and I own my own company, do I have to start paying myself on payroll or put myself on a W-2? The short answer is no, you don't actually have to do that.
This is correct. Take it from somebody who is self-employed. So you could be self-employed. You just need to make sure that there's a few things that are correct when you're starting to apply for a mortgage. So as you know, a lot of us self-employed people, we like to take as much deductions as possible, just because, I mean, let's be real, it costs to be a business owner. So with that, we usually show very, very small amounts of net income per se. Now, Tammer, could you tell us a little bit about showing income on your taxes?
Yeah, so this is important. So as a W-2 employee, if you work for somebody else, your pay is your pay, right? Your gross pay before your deductions, before all those things. They just say, okay, what do you make before all your deductions? As a self-employed person, it's important to know that you actually are represented by the income or net profit that your company makes for you, right? So you can't be showing profits of maybe $2,000, $3,000, $10,000, right? You actually have to have the income of the business represent enough income for the DTI ratios, right? Debt to income ratios that we spoke about before, to cover your mortgage plus all your other living expenses, right? And we've discussed this before. There's a front end ratio, which is just your housing expenses, principal, interest, taxes, insurance on the property. And then there's a back end ratio, which covers the PITI, plus your other expenses that you would have for car payments, student loans, anything, credit card payments, minimum monthly payments on your credit cards, those kinds of things. So the business has to have enough net income covering both the front end ratio and the back end ratio. The other little interesting quirk that's different about owning your own business versus being a W-2 employee. Say I'm a W-2 employee, I've been working in the same industry for 2 years or the same company for at least 2 years, and all of a sudden I got a bump in my salary, right? Time for pay raises, I get a bump in my salary, all of a sudden I go from making $60,000 a year to $75,000 a year, right? They count that $75,000 a year, that's what you're making. That's now your income. For a self-employed person, they're actually going to go back and look at 2 years worth of your net profits, not 1, 2 years of your net profits, showing that you've been earning enough income on average. So first year, you're going to show profits of 70,000. Second year, you're going to show profits of 80,000. They're going to take the average, which in this case, simple math, $75,000. That's what they're going to give you as income. So it's not enough that all of a sudden your business took a massive jump last year. The other thing they're going to ask you for, which they don't ask people that are employees, W-2 employees, is they're going to ask for a year-to-date profit and loss statement. Usually, you can get your accountant to provide you that. You could actually provide it yourself, but they're going to want to see that, okay, and on average for the last 2 years, you were making enough. Plus this year, you're still trending in the right direction to make enough to be able to continue to make your housing payments. So it's, you got your top line revenue, and then you have all your expenses, right? Rent, salaries that you might be paying to other people, material costs, all these other things that you write off as a business owner, meals, travel, whatever, your car usage, all these things are deducted from your top line gross income, right? And at the end, you have your quote unquote net income. What's left over for you? Well, the reason they look at that as what you are making, right, as a owner, is because that's what you theoretically get to take home at the end of the year. Yes. That would be the equivalent of an employee's gross income before they pay their FICO and unemployment and all those other things that they have to pay off of their paychecks.
Yep. And the thing about that I've always loved is like, no matter how much you make gross, right? So let's say that you had a $500,000 gross income for that this year, right? It doesn't matter. That is non-existent in the qualifying factors. It only comes down to the net income. And if you can't qualify with your net income, you probably have to start to pay attention to that in the foreseeable future, as well as like this year and the next year as well, because like Tammer already said, they take those 2 years and then they're going to look at the average amount of income that you have. So even if you had one really great year, it is what it is. It doesn't matter because that's not what they're going to end up showing. They're going to take that average and that's that. No questions about it, sir.
Yeah. No, and it's important, right? And so the misinformation about paying yourself on a paycheck, right, or putting yourself on a W-2 is interesting because they're going to look at that net income number and then they will turn around and add back in what you paid yourself as an employee of the company. So it's actually adding an extra expense to put yourself on payroll or making yourself a W-2 employee in your own business that has no actual net benefit for you as a business owner when you're trying to qualify for a home. This also doesn't mean, though, something very important that W-2 employees don't have to worry about. You actually have to be planning out 2 years in advance. There are actually bank statement loans that you could do, even to buy for yourself, right? Even if you're buying your own primary residence and you want to use your bank statement loans. So they're called bank statement loans, right? They will look at your income coming in and then the money going out, right, from your bank accounts. It kind of ties back into the Fannie Mae conversation we had about credit invisible. It's a similar kind of thing, but with that, again, comes a higher interest rate that you're ultimately going to end up paying, right? And they understand, again, maybe perfect example of this is somebody who might be a real estate developer, right? They get big shots of income in a few short bursts, and then all of a sudden, a lot of money is going out. What they'll do is they'll look at your bank statements over the course of 12 months and add those up, right? What's coming in versus what's going out, what's net left over. They'll add them up, they'll divide by 12, and they'll say, and then they'll figure out what your monthly income is based on that. So there are ways around it. The only problem is, again, it might cost you a little more money.
I don't know. I think personally, like to me, I would prefer to pay more interest on like one of those no doc statements or the bank statement loans rather than paying, hundreds of thousands of dollars to just the IRS for not taking off deductions I already have a right to take off of. Now, that's just my own perspective. But.
No, and I get that. I understand that. Here's the thing, right? You have to think about this, right? It is also a short-term situation that you're dealing with, right? So you do have to plan for 2 years. You're going to have 2 years worth of those, light write-offs that you would normally take, right? And they're legitimate, right? They are legitimate write-offs that you should be able to take, that you're allowed to take within the law, but you might not want to write them off for 2 years. But it's 2 years, and then you go back to it and you go back to getting your write-offs, and that's fine, right? So there's nothing wrong with it in that sense, but it just forces you to have to think and plan a little further ahead than someone who's a W-2 employee. That's all it comes down to.
Yeah, I mean,
you're not stuck. What I'm saying is you're not stuck not taking those deductions forever, right? It's for that period of time prior to getting your approval. Once you're approved, your loan is done, you're good to go. Go back and take those legitimate write-offs that you're allowed to take.
Unless you're going to be doing the bank statement loans, right?
Correct. Then we don't have to worry about it at all, right? Because then, they will look at your income tax returns. You got to be planning on the fact that I want to get a mortgage. So let me start paying my bills on time. Let me, take care of my collections. Like you got to plan, right? I mean, that's the thing about buying a home, right? It's not like a whimsical, hey, I think I want to buy a home tomorrow. Let me go out and go get a mortgage, right? But I do want to go back to what you're saying, right? Paying the extra taxes for those 2 years. It's interesting because if you calculate the additional interest you're paying over the course of 30 years on a mortgage, it might ultimately end up being cheaper to pay those taxes for the 2 years. Again, I don't know your situation. You probably really should be talking to your CPA as well as with your mortgage broker in general to figure out what really makes sense for you in the short term and the long term over the course of 30 years. But again, I don't want to generalize. You just have to figure that out. You have to have those intelligent conversations. And one of the things I always encourage people to do who are business owners who are working with me trying to get their mortgages is connect me with your CPA. Let me have that conversation. Let us get on the same page so that we can figure out what really makes the most sense for you as a borrower. Anyway, so as usual, if there's any questions, if there's any concerns, if you have any, thing that you want to understand about this process as a self-employed person or a business owner, don't hesitate to reach out. We're more than happy to always talk to you. If you have questions you want to just ask in the comments below, go ahead. And we're going to link to our personal contact information to be able to help you out.
Yes, do not hesitate to ask questions. We will answer them. We love questions. It helps us make more educational videos for you guys. And see you guys later. And thank you so much. Please remember to subscribe and like and share. And see you soon.
Take care. Bye, everybody.